One of the other things that's happened over the past year is the emergence of these digital asset treasury companies. So this is like a MicroStrategy type company. It's publicly traded. Its only business model is to own a single token. A couple times maybe it might be more than one token, but most of them are a single token play. And to me, that's just an access play, but they're proliferating. There's a bunch in registration, bunch coming to the market. So Sam, what is your take on those digital asset treasury companies and where's it going?
Well, I don't think that you can underestimate how important digital asset treasury vehicles are to accessing crypto. So let me start with a statistic. Liberation Day, April 1st, Donald Trump declares tariffs, essentially trade war with the rest of the world. U.S. equity markets in the next 5 days have a temper tantrum and lose $5 trillion in value, which is, okay, that's big. The entire world of crypto at the time was worth only $2.5 trillion. So I'm giving you kind of a sizing of opportunity here. Fast forward, digital asset treasury vehicles pioneered by MicroStrategy. Michael Saylor was out front in terms of acquiring Bitcoin on your balance sheet and doing some financial engineering via what's called MNAV, or a multiple of NAV. This worked for a very long time, but what we're seeing right now in the digital asset treasury world is, as I like to say, DAT 1.0 is moving on and evolving into DAT 2.0. DAT 1.0 was about a lot of these companies coming out, being very hastily put together, not understanding that this is a TradFi product that broadens access to the asset class for people who don't want the complexity of crypto rails. Think about the dentist in Oklahoma. Think about, on the institutional side, a college endowment that doesn't want to change their investment charter. Now, all that they need to do is have a prime brokerage account or a Schwab account, and they can access the asset class, right? So from that standpoint, that's a great innovation and is broadening access. From a financial engineering standpoint, a lot of these were sold as an arbitrage play to access a multiple of the NAV, or net asset value, of the crypto that the particular company holds. I said this several months ago at the Out East Summit, and I was almost laughed out of there when I said MNAVs greater than 1 are unsustainable and certainly not greater than 2. And the industry was really focused on this MNAV thing. I think going forward, what's happening is the market's maturing. 50% of the treasury companies on Blockworks that are being tracked right now in terms of MNAV, fully 50% of these are trading below 1, which that sounds like an arbitrage to me, and only 2 trade above 2 MNAV. So I think DAT 2.0 is more about understanding this is a TradFi product. You're going to see higher quality deals coming out with TradFi or traditional finance executives and boards with a focus on increasing the number of tokens per share rather than a multiple of NAV. And how do you do that? Well, you start by saying, I'm not going to go out and spend all this money that I've just raised in one weekend and let the market essentially take the opposite side of that, which is exactly what happened for the past several months. And trust me, this was a really good trade to take the opposite side of in the crypto market. But from a DAT 2.0 perspective, you want to buy your tokens opportunistically. You want to buy your shares back and have dry powder to be able to defend that. Tom Lee at BitMiner has written the playbook. I think it's going to continue.
Great, thanks. And John, from your perspective, looking forward the next 12 months, whether it's regulatory, legislative, or just business-wise, what do you see happening?
I'll note that we have a precedent for digital asset treasury firms in TradFi. It's Berkshire Hathaway. Berkshire Hathaway is a stock asset treasury firm. It's a guy who for 40 years or so has been buying 7 to 9 publicly listed stocks that any of us can buy. And by the way, there's not just Berkshire. There's a litany of Berkshire lookalikes that have all traded above par value of their underlying. And we trust them. So I view DATs as, quite frankly, liquid hedge fund vehicles. And the better ones will survive, and the bad ones will go away. And I think Sam's right. So I don't know if they trade below 1 forever, but certainly below 2 and somewhere in between. I go back to my original point. I think the most exciting thing next year is to see, and it may take longer than a year, is this army of brokers really excited about selling this asset class. That's what we've never had. We've never had, like, who are the killers? I've asked every crypto firm that's come to me with an idea. I'm like, this all sounds wonderful. Who are the killers who are going to be working the phones, working the rooms, working the golf courses? Because again, I think for the foreseeable future, these will be sold, not bought products. And you got to have your killers. You got to have your army. And we haven't had that army. Now, what we had is amazing marketing. In the sense that everyone's heard of Bitcoin. My mother's heard of Bitcoin, right? That's wonderful. So when products, you don't have to spend, at NYMEX, we used to develop these wonderfully beautiful instruments. They like perfectly solved a value transfer, risk transfer problem the OTC market was happening, right? Remember, what was his name, the head of research? Smart guy.
Bob Levin.
Bob Levin. We sit in a room, we say, okay, the OTC guys are trading this. Let's make it a fungible instrument, work all the math out. Oh, there's a thing of beauty. Let's list it on Clearport. Like it just wouldn't trade. And we didn't know why, because there was market. I remember, I'll tell you a quick story. I remember when the jet fuel contract launched, like people weren't buying it. And I remember going into marketing and they were on the phone with like the airlines. They were like, hey, you should use this thing to hedge your, and the airlines were like, the CFOs were like, no, we don't do that. We don't hedge. We don't speculate. We had to talk to the analyst, the equity analyst, to say the next time some idiot says he missed earnings because of rising jet fuel prices, say, why are you speculating? You are short jet fuel. Use the derivative to not speculate. Until you hedge, you're speculating. But it took a while for that mental switch. So you need the killers, you need the salespeople. So that's what I'm most excited about.
I love it. Yes. He who controls the narrative controls the market. That's excellent.